gas production fell by 6.8%, oil production by 14.8%, and electricity consumption and production reduced by 3.6%. So where is this coming from? It's coming from an increase in subsidy, which has got nothing to do with real economic activity. So a lot of this data is not reflecting that. Just the halving of the policy rate should have resulted in the doubling of the stock market prices. So therefore, the initial increase, which looked tremendous, and people said, no, but there is no real improvement in the economy. It made sense simply because of those fundamentals. From here onwards, this growth is going to be sustained if there is earnings growth of the listed companies. And at this point in time, if you see the data for the first 3 months, for the reports which have been released, the earnings growth is gone. You're seeing a flattening of the earnings, and in many sectors, a reduction in earnings. For example, banks have seen a reduction of earnings. So therefore, going forward, it is not going to depend on the improvement in the real economy, which we were discussing earlier. If there is an improvement in the real economy, if there is earnings growth in the listed companies, then you will see valuations improving in the future. As revenue shortfalls take place, as FBR is unable to recover the targets which have been set for them, we see one cut after another in the PSDP. And as a result, what has happened is that the total development expenditure, which even just 10 years back used to be about 4.9% of the GDP, had last year fallen to only 2% of the GDP. That's like, it's more than halved in just the last decade. And if you go back about 30 years, it used to be more than 7% of the GDP. What we have done in terms of infrastructure financing, in terms of sectoral allocations, the priorities, like what we had reflected in our last PSDP, was we had increased significantly spending on education, on climate, on industry, on agriculture, and on health.
Although this year we saw some macroeconomic improvement. Fiscal deficit came down to 2.6%, inflation dropped to 4.7%. And there was even a current account surplus. But to make sure that this isn't just temporary and it's sustainable, what reforms or safeguards do you think were actually put in place? And how prepared do you think we are if there's another external shock?
Okay, so just starting from the last part of your question, we're not prepared at all. We are in a very, very vulnerable situation. And the reason for that is that the improvement in numbers that you just mentioned are mostly not coming from any improvements in the real economy. Let me explain that a bit. Let's first disaggregate the GDP growth numbers, and then I'll talk briefly about the current account deficit. GDP growth headline is 2.68, let's say 2.7%. That's just barely above population growth rate as it is. And if you look at the historical context of Pakistan, it's one of the weakest years that the Pakistani economy has seen, just to put things in perspective. But if you disaggregate that, you will see that large-scale manufacturing is negative. It shrank last year. Major crops were a massive whopping 13.5% negative. Your gas production fell, your electricity consumption fell, your oil production fell. FDI reduced. So the real drivers of the economy are really all showing extreme weakness even today. So there is macroeconomic stabilization. Your reserves have gone up and stabilized at still a low level, but they have stabilized. So the stability has come, but there is no sign of growth. In fact, there is extreme weakness in the economy. Similarly, on the current account side, your trade deficit actually increased by $3.4 billion. Goods and services put together, you had a $3.4 billion increase in the trade deficit. Similarly, I already mentioned FDI decreased. The improvement has all come from remittances, which is fantastic. It's a good thing for the economy, but it's got nothing to do with the performance of the economy itself. So therefore, we are still not seeing any signs of a sustainable recovery in the real economy.
You mentioned large-scale manufacturing, which went down by 1.5%. Private investment went up by 9.9%, and public investment jumped by 34.2%. But like you said, despite that, large-scale manufacturing still shrank. What do you think held the industry recovery back? And how do we explain this mismatch, more investment and weak industrial performance?
Okay, so first of all, how worrying are the trends in large-scale manufacturing? You have to actually go beyond the current year. So 1.5% decline, as we discussed for this year, uh, but the manufacturing output, the large-scale manufacturing output, is actually down by more than 10% versus where it was 3 years back. That's absolutely staggering. It's never happened in Pakistani history. And remember, this is happening in a year in which there are no floods, no earthquake, no COVID, no external shocks. And despite that, your industrial production, your large scale industrial production is down more than 10% versus where it was 3 years back. So there is extreme weakness. And where is it coming from? It's the shrinking purchasing power and the consumption spend of the consumer. That's what's driving this weakness. Both business and private citizens are not spending, or the spending growth is not keeping up with the inflation that has taken place. So that's the context in which you're seeing the current numbers. And the public sector investment numbers, the PSDP was at an absolute record low last year. You know, they were fighting default. So they just kept cutting PSDP again and again and again. So this is just the return to normalcy. This is no fantastic public expenditure numbers.
Yeah, so there's no growth as such. It's just stabilization for now. Um, you mentioned crops, and we had no floods, nothing this year. But agriculture only grew by 0.56%, and key crops actually dropped by 13.49%. And so, like you said, there were no floods, right? There were no climate crisis this year. So, what do you think went wrong in this sector, and what could, the government do?
To improve the situation. So let's first delve into that just a little bit more. Major crops, which are very well documented, declined by 13.5%, and minor crops, which are not so well documented, supposedly grew by 4.8%. Same thing happened in manufacturing, by the way. Your large scale manufacturing shrank by 1.5%, and small scale manufacturing grew by 8.8%. They're facing the same macroeconomic environment, the same consumer. So it's highly, highly unlikely that you'll see such a divergent trend there. Similarly, if you look at in fact, the fastest growth number in the GDP data, if you look at it, is coming from electricity, gas, and water. That's 28.8% growth is coming in that year. And as we just discussed, gas production fell by 6.8%, oil production by 14.8%. And electricity consumption and production reduced by 3.6%. So where is this coming from? It's coming from an increase in subsidy, which has got nothing to do with real economic activity. So a lot of this data is not reflecting that. Now coming to your question on agriculture, it's been a combination. Part of it has to do with the fact that you have gone through a increasingly severe climate change impact as a nation, right? So there is the contribution from that coming in also. But at the same time, your farmer will invest when he gets a return for the previous crop that he put in. If you look at the data for major crops for the last few years, or agriculture as a whole, farmer incomes have been extremely weak. So just to quantify that, in the last 3 years put together, the major crops increase is only 1.3% per year. The value-added increase is only 1.3% per year. In the 2 years prior to that, from 20 to 22, the increase was 5.6%. So it's less than 1/4 of the growth, with very weak purchasing power in the hand of the consumer. And remember, the farmer is also facing the general inflation, which went up as high as 38%. So the purchasing power is constrained, spending power is constrained, so therefore inputs are not being put in to the level which are required, etc. And then this whole fiasco of how the wheat crop has been managed really made everything worse. It's the biggest crop of the country, and when you have such a disaster, the wheat prices for the farmers went from 3,900 down to 22,300. That's devastating. So it's a combination of all these factors. And agriculture has a major spillover effect on other sectors. So the weakness that you're seeing in large-scale manufacturing, the question that you were asking earlier, is also caused by the extremely poor performance of agriculture. We know this, whenever there are good agricultural crops, it has a spillover effect on manufacturing as well.
Yes, you're right. And so you also spoke about inflation, but inflation did sharply drop to 4.7%, which is a big change from the double numbers that we saw before. But so, but again, like you said, the purchasing power is still the same. So what do you think were the key factors behind this decline? And do you think this inflation rate is here to stay, and will it reflect in the way people?
So yeah, first of all, just putting the inflation number this year into context, inflation is the rate of change in the general price level. It is not absolute prices. So when we say inflation has come down, that doesn't mean prices have come down. It is simply the rate of increase of prices has come down. Cumulative over the last 3 years, even if you take this very good number of 4.7%, you have had almost a 50% or more than 50% increase in prices. That's phenomenally high price increases over a 3-year period. What has contributed to this decline? One is that base effect, because the prices have gone up to a very, very high level. Secondly, the stability of the exchange rate has been a positive, because the exchange rate has been stable. So therefore, that aspect of it has contributed to the lowering of the inflation level. And the third thing which has happened is that post-COVID, there was a supply shock in the global supply chains. And as a result, commodity prices of all kinds went up. Oil price, if you remember, was above $100, close to $110, and it's going around at around $65, $66 at this point in time, the Brent crude price. So commodity prices have globally come down. So combination of these three factors, a high price base effect, a stability in the exchange rate, and the global reduction in commodity prices, these three things have brought the inflation rate down for this year. But as the government itself and the state bank has said, this is a temporary phenomena. And if you have seen in the last month, you're starting to see a kick up again. Hopefully, with the right monetary policies, with the right fiscal policies, you will be able to contain inflation going forward to within single digit, and that's what's required.
Okay, so after the inflation fell, the state bank cut policy rates. And do you think it was the right time to do that? And do you see any risks from this move, like exchange rate instability or capital flight?
Actually, the State Bank of Pakistan was frankly late in the reduction cycle. Uh, Inflation, the monetary policy is supposed to be forward looking. It doesn't look in the mirror. So it is not supposed to be based on the reported inflation data for that month or the previous month or over the last 6 months. It's supposed to look forward next 6 months, next 12 months. So if you look at that, and a lot of the economists, a lot of even independent brokerage houses were predicting a significant moderation of inflation, and therefore the rate cutting cycle should have started a bit earlier. On the other hand, this demand by the businesses to cut the policy rate into half and bring it down to 4 or 5% doesn't make sense. Pakistan needs to run positive real interest rates. It is right now running those positive real interest rates. We are coming close to the point where you're going to run out of room for further cutting of the policy rate. So at this point in time, after the last 100 bips reduction, we are more or less at the right place. And if inflation continues to stay contained at, say, about 5% or so, which is what the government is hoping for, and the current account deficit continues to be contained, then there might be room for some further cut in the policy rate, but not a significant one.
Okay, despite all of this, we saw the KC 100 index. It went up by more than 50%. It was one of the best performing markets globally. Do you think this was driven by real fundamental changes, or do you think it was more about sentiment? And do you think it's
So
sustainable?
no. So the increase which happened earlier, let's say over an 18-month cycle, was driven by good fundamentals. And what were those good fundamentals? It was the inflation coming down. The sentiment improvement with the IMF agreement coming into place, and therefore the risk of default. So that default risk first went away. So you got one bump in your valuations. Then as the interest rate, as the inflation kept on coming down, interest rates kept on coming down. So the policy rate has been halved. Everything else remaining the same. You know the way a stock price is supposed to be calculated. It is the discounted present value of all future cash flows, and the discount rate is pegged to the policy rate. So everything else remaining the same, just the halving of the policy rate should have resulted in the doubling of the stock market prices. So therefore, the initial increase, which looked tremendous, and people said, no, 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 but there is no real improvement in the economy. It made sense simply because of those fundamentals. From here onwards, this growth is going to be sustained if there is earnings growth of the listed companies. And at this point in time, if you see the data for the first 3 months for the reports which have been released, the earnings growth is gone. You're seeing a flattening of the earnings, and in many sectors, a reduction of earnings. For example, banks have seen a reduction of earnings. So therefore, going forward, it is not going to depend on the improvement in the real economy, which we were discussing earlier. If there is an improvement in the real economy, if there is earnings growth in the listed companies, then you will see valuations improving in the future.
Okay, so now I'm going to ask you, with the budget coming up, what do you think the budget should look like if you want to recover, if you want a sustainable economy?
Okay, so in my mind, and I've written about this also, there are three questions, the answers to which will determine, at least in my mind, whether it's a good budget or not. Question number one is the fiscal deficit being reduced. And fiscal deficits, we have been running way beyond our capacity. And as a result, we have fallen into a severe debt trap, which is so severe that now we are borrowing not just to repay the previous loans, we are borrowing even to pay the interest cost on the previous loans, right? So that will be the first thing. Is it showing fiscal responsibility? Is it showing a reduction in the fiscal deficit? And most importantly, the most crucial number will be the primary deficit. Are we running primary surpluses as we want to run there? The second part of it is going to be, okay, if you've satisfactorily answered the first question, i.e. your primary surpluses are looking good, your fiscal deficit is coming down, how has this been achieved? Has it been done in a fair and just manner? And what I mean by that is the burden being placed on those who have the capacity to pay? And is it protecting those who are the most vulnerable? If you look at the last budget, what have we done? We have recovered something like a colossal 50% increase in tax collection from the salaried class. We have just made mincemeat out of the salaried classes in the last budget. A 4.7% inflation and a 50% increase in taxes. That's just remarkable. And what were we able to do in collection of taxes from the retail sector? I think a sum total of something like 100 million rupees is all we have collected, whereas the increase in tax collection from the salaried class is like 150 billion rupees. That's rubbish. That's just unjust and unfair. So will we be able to stop the massive parking of tax evaded money going into this black hole called the real estate market of Pakistan and recover the due taxes from there? Will the large landholders, the large agriculturalists, will they be paying a fair share of tax? Will the retail sector finally start to pay a fair share of taxes? And in my opinion, the budget should reflect both a reduction in the tax, the absolutely unjust taxes which had been placed on the middle class in the salaried class, as well as the formal documented corporate class is now, companies are now overtaxed. You are killing the goose which lays the golden egg. And we have reached a point, as a result of it, what are we seeing? The largest number of Pakistani professionals migrating out of the country and going to work abroad, and a massive amount of wealth transfer taking place unofficially. Talk to any banker, talk to people who are in the financial system. Massive amounts of money have been taken out by the Pakistani businesses because the formal documented economy is getting overtaxed now. So we should see some very substantial tax measures, both positive and negative.
What about the PSDP? Because what we're hearing now is that they're going to massively cut down on PSDP. And do you think we're going to see more targeted development spending this year, especially on climate resistance or infrastructure? And how do you think the government can ensure the PSDP allocation actually translates into on-ground results and not just paperwork? Because we do see a lot of, the funds are just not used.
So yeah, that's very interesting. In the last 13 years, there has been only 1 year in which the full PSDP allocation was utilized. And if I may say so, that was the year that I was the planning minister. The PSDP numbers have been increased substantially from what we hear. It will be announced this today. But we believe that it's going to be a much bigger allocation. But we've seen bigger allocations in the previous two budgets also. And what PSDP is now being used at is actually a contingency fund. So as revenue shortfalls take place, as FBR is unable to recover the targets which have been set for them, we see one cut after another in the PSDP. And as a result, what has happened is that the total development expenditure, which even just 10 years back used to be about 4.9% of the GDP, had last year fallen to only 2% of the GDP. That's like, it's more than halved in just the last decade. And if you go back about 30 years, it used to be more than 7% of the GDP. What we have done in terms of infrastructure financing, in terms of sectoral allocations, the priorities like what we had reflected in our last PSDP was we had increased significantly spending on education, on climate, on industry, on agriculture, and on health. And our infrastructure spending was, as a proportion of the total, was reduced. But why was it reduced? Because we were finally utilizing the public-private partnership investment framework which had been put in place, and for more than a decade governments had been struggling and they were unable to utilize it. And our projects, the Sialkot Jhelum Expressway, the Sakkar Hyderabad motorway, etc., all these projects were now being done under this public-private partnership framework, and as a result, reducing the burden on the PSDP itself. So that's what, and we have seen that the work on the public-private partnership has again stopped. That's absolutely essential. In a tight fiscal space, you'll never be able to spend that much money from the budget itself. So we need to have those priority sectors, the social sectors, climate, etc., agriculture, the real sectors which run the economy, agriculture, industry, getting higher allocations, and the infrastructure funding being done more and more through this public-private partnership.
All right. Thank you so much, Asad, for joining us.